Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. It's 1 o'clock on the East Coast. Elizabeth is turning her phone off.
Well, do not disturb.
By the way, I have a good Elizabeth story from yesterday. You almost jacked somebody up.
No, let's not. No. Maybe she's listening.
Doubtful.
I had a dust up on the sidewalk.
Isn't that? She was walking with her bags.
She's becoming real New Yorker. You would never do that in Milwaukee, like if it was Laverne and Shirley or Laverne and Liz.
No, Liz was just minding her business. Beeswax. Yeah. Anyway, it's let's say Wednesday, the 14th of August. Yeah. It's market call. Dan, why is the market higher today?
Because it's open, guys.
Truly is. Yeah. S&P up another 8 handles, but you know, we'll dissect the VIX is down below 17 again, as if of course it is, as if nothing ever happened. Elizabeth, good to see you.
Yeah, good to be here.
You had that dust up. You were carrying groceries.
Yes.
Somebody sort of ran you off the road.
Just pushed me right in the middle of the sidewalk.
Uncool.
I made it clear that I did not appreciate her behavior.
In not so many words. Good for you. Dan, how are you? You got your master's vest on.
I do. It's just like the uniform guy, as you know. All right, should we get to the rundown?
Put it up. We got a lot to do. We got all the stickers up.
We got to hit the CPI. Liz, you've been tweeting like a fiend about it. Inflation hits lowest level since 2021. We got to go over a little bit of this Home Depot guy. It's signaling. I don't know what it's signaling, but it's something not so great for the consumer, the way that they guided. I don't know if we hit that a lot yesterday. I know on Fast Money last night, you talked about the reversal there. We were all a bit surprised. This is an AD. That would be Amanda Diaz special here. Panic at the CSCO.
No, okay, so why is there a ball there? That's like a disco ball.
Yeah, Panic at the Disco.
Panic at the Disco.
It's a band.
It's a band.
Guy, come on, stay with
us.
us.
Seriously,
I think Panic has an exclamation point.
I didn't know that.
And then
so there's a band called Panic at the Disco.
Yes.
Would I know any of their music?
You would not.
No.
Then we're going to hit big tech's regulatory.
That comes in the form of Google.
You know, we've been talking about this for a long time. And we kind of, you know, every time Melissa Leo will look at us or Scott Wapner looks at you and says, is it going to finally be this DOJ suit or this FTC?
Correct.
And it's just so easy, Guy, to just disregard them because there's never been any teeth. But this story, this is out of Bloomberg, it looks like they're talking about how to break up this company.
I've seen people discussing it, saying this one may be more important than the market's realizing or caring to acknowledge. We'll see. But this comes, I think, you know, it's one of those things, until this thing gets legs, I don't see any reason necessarily to get negative on Google. That's just me.
Well, let's just look really quickly because we're kind of just jumping ahead here. Let's just pull up that chart. This morning at one point, the stock was down nearly 4%, which I just surprising. And, you know, it maybe speaks to the sort of environment the Mag 7 stocks have been in for like a month or two right now, is that investors are kind of shooting first, asking questions later. Look at that level, guys.
Well, that's the right level.
Look at how the 200-day is right up on that. So, and it's also the low from last Monday.
So if you look at, you know, what that horizontal line suggests, I mean, the prior all-time high in Google, I think, was back in, well, if you go longer term than that, just to go back to 2021.
You're going to pull up a little double.
And you'll see, you'll see that. So those prior highs, I mean, that's sort of 148, 149. I think we're trading about 159 now. So maybe that's your ultimate support level. But you mentioned the 200-day moving average is right here. You know, we'll see. You filled that little gap to the upside that we saw earlier this year.
Yeah.
Again, typically, and maybe this is the beginning of something, but, you know, historically, these just become sort of a, you know, we talk about it for a few days and the market moves on.
Yeah, just really quickly, Liz, before we get to CPI, I know we're getting bogged down in a little Google here, but when you look at this, and I know, Guy, you've mentioned, you know, valuation on this name on many occasions, trading 18 times next year, expected EPS growth of 12% with revenue growth of about 13%. And then you think about the margins here, you've seen a steep drop down from last year, nearly 68 to expected 62.5 this year and below 62 next year. So there is some sort of like earnings degradation that's being kind of priced in here. So maybe that's one of the reasons why it's trading cheap to the broad market and many of its peers. All right, Liz, let's do it. CPI this morning, PPI 2 days ago. You've been tweeting up like a fiend. This is not your Super Bowl the way the all-important jobs report is, but put the two together. Some decent movement yesterday.
Yeah, well, my Super Bowl is usually Fed meetings. And what's interesting is, and we put a chart about this in the column this week, is that the market has decided that CPI is just not as important anymore. I think today the positive reaction, although it's a very muted positive reaction, the market's pretty bored with this print. Nothing really happened. I think really what did happen here is that we were bracing for impact because now we're sensitive after that jobs report that came out a couple of weeks ago. Everybody's nervous that the next data point is going to send us in one direction or another. So we braced for impact. And then this was a very vanilla report, pretty much bang on expectations. The other thing, one of the things that I tweeted today, so if we don't have the chart, it's fine. But
we have the tweet, consumer price index month over month with the pretty colors, I believe.
That one, but there was another one I tweeted today about basically inflation swaps and what the market is pricing in. So if you look at what the market is expecting on CPI going forward, we're actually expecting some one handles coming up if we look out into the future. So I think today this was like crisis averted. CPI didn't come in too hot. It wasn't cooling too much. But again, the takeaway here is it was driven, even though it was still growing, only really driven by shelter and by car insurance. So there are a lot of components that are not rising as much anymore. And Guy, I know I don't have to tell you this, but the inflation index hit a new all-time high, which it has every month, every time, because prices are still rising, because CPI is still positive.
Right.
So there's this whole belief that, okay, everything has come down. We have slayed the dragon. The problem is solved. Yes, the problem has gotten better. It's gotten smaller, but it still exists. And we still have price pressures and things that have risen and are going to stay high.
Without getting all wonky, because we want to be more actionable, as they say.
Yeah.
But if you think about it, Elizabeth, so the Fed's about to start cutting rates at a time where shelter continues to be sticky as hell. So what is that going to do? It's just going to, I think, make this shelter problem in the form of real estate, rents, ownership. It's not going to help it. Let's put it that way. I mean, it might not hurt it, but it's certainly not going to help it. And that's going to stay sticky as hell.
Well, it's interesting, guys. So I saw that like week over week, the interest in home equity loans or the applications is up like 35%. Okay. So there's another way to think about this, right? If you've seen this massive price appreciation for housing, okay, and a lot of these mortgages are below 3%, right, from 6 to 9 months ago or whatever prior to that, then you unlock that home equity loan. Well, that might be the sort of thing that a mid-level sort of consumer can start getting back there. Now, the flip side of that is if housing becomes more affordable, then you would assume, right, that rents will come down, which is a big component of that. So again, I mean, it's not so easy to do this. I just want to make one point. You know, David Rosenberg Research, he has a great note. Rosie, it's breakfast with Rosie or mornings with Rosie. He gets it out early too, man. Some of these guys, Doug Cass, they are up early writing their notes. Okay, I just want to go over this really quickly and maybe get both of your reactions here. The shape of the curve is such that the Treasury market is telling the Fed that it's 250 basis points behind the curve, and the 10-year tips break-even level is rapidly approaching the Fed's target of 2%. In fact, the 5-year market-based inflation expectation measure fell 2% or below 2% at the beginning of August, now 1.96% to the lowest since January of 2021. I think this is interesting because we've been talking about the whole idea of real rates and, you know, all this sort of stuff here. What is restrictive? And that, let's speak to this a little bit, because Rosie, very interestingly, we're going to read another quote from him. He thinks we are headed to a recession far quicker than I think many strategists on the street, but he's also been banging the inflation drum to the downside for over a year now.
Okay, so a couple things. First of all, just for everybody watching, where do you get some of those numbers from? So generally, the thought is that the Fed tracks the 2-year Treasury, or the 2-year Treasury tracks what the Fed will do. So if we've got a 2-year Treasury right now at a yield of 3.95, that would suggest that in the next 2 years, at some point, the Fed's going to have to lower rates at least 150 basis points to come in line with what the 2-year Treasury is saying. I know we're talking about the 10-year tips break even in that message there, but even if you just look at the 2-year break evens, we've got an inflation expectation of 1.6%. So again, quite a bit lower than not only where we are, but also quite a bit lower than where the Fed funds rate is right now, which basically bottom line says we are restrictive, probably too restrictive. So what do we do about that? What does the Fed do about that now? The Fed obviously has to somehow slowly get down to a more manageable level or normalize rates. My opinion is that they should have started doing that already. I've mentioned this before. If they wanted to do it gently, if they wanted to send the message that they could do this in a normalizing fashion, they should have gotten started. Now that message is all but lost, and it's going to look more reactionary because we've already gotten nervous about how much cooler the data has gotten. So the last thing I'll say is, if Rosie's been calling for a recession to happen much more quickly than people expect, I would suggest it always happens much more quickly than people expect, because you don't really see it coming. And then all of a sudden it's there right in front of you. And it's this big thing. I mean, just like last Monday happened much more quickly than people expected. So it's very possible that it happens more quickly than people expect.
Guy, you've been saying this, I think, for a year, and probably on many different occasions, that the Fed has really painted themselves in a corner, right? So, Fed Chair Powell a few meetings ago said, we're not going to wait until inflation gets to our 2% target. And it almost felt like a mission accomplished sort of thing that they were able to do. But to Liz's point now, they seem a bit reactionary.
Well, first of all, I think they're out there way too much. I mean, as much as they want to be visible and they want to sort of, be as, I guess, transparent as they possibly can be, I think in that transparency, they do themselves a huge disservice. I mean, I sort of yearn for the days when you didn't know who any of these people were, and they sort of were in sort of the ether out there and doing things from time to time. With that said, I do think they painted themselves in a corner. Elizabeth just said it. So whatever they do now is going to appear reactionary. And if you go back and look, when the rates start getting cut is the wrong time to sort of be balls into the market, full in, all bore market bull, because that typically is when things start to turn. And again, 2s, 10s, which I think went to parity on that Monday of last week, that's going to, it's re-steepening before our eyes. That's also historically, that's been a signal as well that things are probably not going as well as people think.
One of the other things that I think people have to keep in mind is, because we're going back and forth between 25 basis points and 50 basis points in September, some of the commentary has been, well, 50 basis points would be so dramatic. And if we did 50s and 50s in a row, how dramatic would that look? We forget very quickly that they did 375 basis point hikes in a row on the way up. So I don't think it would be that dramatic on the way back down if we're trying to get back to whatever they think neutral is, to do some 50s. It's not that big.
Isn't it fascinating? So that happened in 2022. The stock market, again, no one knew where it was going to bottom out, right? But it crescendoed into late 2022. They're already done with those three, hikes there. But it's interesting. It didn't do much to the economy in 2022. You know what I mean? Like, yeah, we had a little bit of an earnings recession, and that was kind of a bit of a hangover from 2021 and everything like that happened. So it's interesting that it kind of destroyed the ability for people to buy homes, the way that mortgage rates went up. The stock market went down. So you had the negative wealth effect there, but for all intents and purposes, the economy just kind of hung in there, So again, all right, that was our want. Do you want to talk, Liz? You had in your note, you had this chart about household income and the like here, because I think this is interesting.
The note is called demoted, and what I'm talking about is the demotion of inflation in the market. Apparently, we are not as interested in inflation numbers anymore. We're much more interested in jobs numbers. And some of the fear, and now, Guy, I think you and I are on different sides of the fence on this argument, but the fear had been, and this is about Fed cuts, the fear had been that if they cut too soon, they're going to reignite inflation. We're going to see this resurgence. So my take in this article, and this is sort of the second half of the article, is that I think that fear is now much smaller, because we have not necessarily damaged demand, but we've done enough damage or shaken sentiment enough that I think it would take more than a couple rate cuts to get consumers to come back out of the woodwork and start spending a lot more. And the chart that I showed here is part of why. So this is part of the Conference Board Consumer Sentiment Survey. This is what consumers expect their real household income to be in the next 1 to 2 years. That is at the lowest level since 1980. Okay. Now, what does that mean? That means that basically the question is phrased as such, something along the lines of, do you expect your household income to be higher a year from now or lower a year from now? Most of the respondents have said they expect it to be lower a year from now. So if I'm a consumer, I'm suddenly shaken by what happened in the jobs market, right? Unemployment went up a little faster than I thought. And I'm answering questions like this because, number one, inflation has taken more of a bite out of my income than it did before. And I'm not expecting my income to go up to make up for that. It's going to take more than a rate cut or two for me to start going back out and spending money like I was hand over fist a year ago, 2 years ago. So I think that the demand picture has been muted enough. The one caveat is, how does inflation go up without demand? It goes up with some kind of exogenous shock that drives energy prices up or drives input costs up, something that a natural disaster, things that are outside our control. But what I would argue in that regard is that that's always a risk.
Right.
There are always risks for exogenous shocks. And unless they become more imminent or obvious, you can't really invest based on that risk.
That's fair. And I think you're exactly right in the way you sort of broke it down. The risks of exogenous events and the supply side of the equation getting taken off the market and then obviously reigniting inflation is always there in one way, shape, or form. I would just throw out that in the environment that we find ourselves in, those risks seem to be heightened for whatever reason, just given what's going on. And again, if we were to see a precipitous move in the dollar to the downside for whatever reason, I just think by virtue of that, you're going to see sort of a reignition of these really important commodities, energy, industrial metals, and those things. With that said, if you think about what people are saying, I mean, they're not confident about things, and it's manifesting itself in this survey, in the president's approval rating when it comes to the economy. And when the consumer is not confident, they're only going to spend money on what they have to spend on. And if consumer spending is a big part of the equation, you're going to start to see things ratchet down really quickly.
It's interesting. And, we read a lot of stuff each day from a lot of different strategists, economists, market participants. We have them on our shows. We have them on CNBC. It seems like a universal agreement that the consumer is slowing, but many of those people who are willing to admit that are not suggesting that we're going to have a recession anytime soon. I know Goldman has ratcheted up their recession call to 41% or so. I think JP Morgan is 31%. I think that's over in the next year. So as Rosie was saying, put it right there in the middle, two big houses saying 35%. Who knows? I just go back to one of the reasons I'm like hesitant to just get too bared up right now is like I was kind of that way in 2022 and it just didn't. There's always some wrinkle, you know what I mean? So, all right, I just want to go to the S&P chart here, Guy. You and I talked a little bit yesterday about how quickly the sentiment went from downright awful. You know what I mean? When you think about the Monday price action, the Monday opening was the low. We're up about 7% since then. It's interesting where we topped out today. Amanda, look at her just making that little chart.
That's beautiful.
Look at that, guy. Look where it stopped, as Carter would say, to the penny. Now the downside of that is just 2 points, but if we look at where the 200-day moving average is, if we were to kind of get repelled here at resistance, Guy, that 200-day is easily in place, and I think that's the sort of thing. A test of that will make a lot of people feel like we've taken a lot of froth out of the market.
Yeah, as we talked about this yesterday, it looks a lot like April in terms of that downdraft and then the subsequent bounce. I mean, in April, we didn't get down as close to the 200-day moving average as we had now. However, it didn't last very long to the downside. What's interesting, I saw Lori Calvasina, who's been on our podcast. I know EYT knows her as well.
RBC Capital.
What she said today was she went through the data and looked, and the futures market suggests and the positioning market suggests that nothing really changed on that sell-off. In other words, longs didn't get out and shorts didn't get in. Nothing really changed. I mean, the market obviously had a pretty significant move, but in terms of positioning, pretty much the same as where we were, which suggests that maybe there is another leg lower, because if nobody got out and people are still sort of bulled up, confident and long, if nothing has changed on that front, there's always that danger to the downside.
Monday moved so quickly. I doubt that too many people had a chance to kind of add to too many things when they were in the hole. Hey, just a little housekeeping really quickly. If you want to get demoted, that is Liz's latest note. No,
rude.
I don't mean like if you want to get demoted. If you want the piece to be delivered to your inbox, go to SoFi.com/on-the-money. I'm just going to keep saying it like that until we kind of change that handle a little bit. And Liz, you're doing a little something this afternoon. What's moving the markets here? How can people tune into that? That will be 4 p.m. Eastern time, 1 p.m. Pacific if you're around.
Yep. This is for SoFi members or anybody who wants to listen. Just doing a quick little presentation on what happened last Monday. What did CPI mean today? This is a series we might continue doing as fall goes on, just because it seems like there's going to be more market moving events and people have questions. They want to understand it.
I love that. Are you going to answer questions?
I am going to answer
questions.
questions.
And is it just you?
It's just me. Yeah.
Wow.
So it'll be differentiated from today's market call. All right, guy, here's one for you. This is also from Rosie here, and I thought this was interesting. This is about Home Depot, okay? He said if it didn't just trim its sales outlook for the year, it slashed the forecast to between -3% and -4% year over year from prior projection of down 1%. Oh, but there's no recession coming because obviously it hasn't shown up yet. Sure thing. So that's meant to be in a sarcasm font guide. We don't have that yet.
We don't have that yet.
Yeah.
HI, or what is AI? HI. They
Generative
haven't
AI,
done that
the
yet.
artificial intelligence.
Now they have commercials for it on TV,
all over the place,
which
it just really
I want to
frosts
throw.
your-
It does. It frosts my nuts, if you want to know the truth.
Well, you know who it's Google right now, and it's Meta, and you're going to see an
whatever.
onslaught
It's
of Apple Intelligence ads starting next
Good luck,
month.
people. Enjoy your lives. What's left of them. So this is interesting because what we talked about was the potential for a relief rally in Home Depot, given how poorly it's been trading over the last couple of years. And if comps weren't a disaster, we knew they were going to be bad. But if they weren't sort of minus anywhere from -3.5 or worse, you'd probably get this. So on one hand, the commentary is dreadful. On the other hand, you probably priced so much bad news in that we were due for a bounce. I don't think Home Depot is out of the woods by any stretch of the imagination. And as I said last night, this bounce will probably last a couple days, then you fade it again. Rosie is right to point out that when you hear companies like Home Depot with commentary like that, you can dismiss it, but you have to at least read it and try to understand what's going on.
So let's do devil's advocate. How does Home Depot bounce and stay up? I actually think it's part of Dan's thesis from before. If people are taking out a bunch of home equity loans, what are they doing with those home equity loans? They're improving their current home. They're not buying a new one, and that benefits Home Depot and adjacent companies. So that's the way that it would go up and stay up. But that also speaks to, it would require consumers to be confident enough in their own spending and taking on more debt in order to do so. I am not of the camp that people are there right now, but that would be the other side of the coin.
So I will devil's advocate
your devil's
advocate by saying, yes, I think there's definitely the case to be made that if people get these lines of credit, they will use it to improve their homes without question. We've seen it before. There's another school of thought that suggests maybe they'll use it to pay down credit card debt, which has gotten to pretty ridiculous levels at pretty ridiculous interest rates. So there's that, your point, and there's my point. Typically, it's some amalgam of the two, but I think more people are more focused on trying to pay down debt at this point than maybe improving their homes. But that's just me.
Quick story, quick caveat.
Is this an anecdotal thing?
I think I've told you guys this before. I was very young in the industry. I was in college. I worked as a bank teller for a while.
Love that.
It was a credit union, technically. At that credit union, this was during 2004-ish, maybe mid to late 2004, home equity lines of credit had picked up as this hot new borrowing. And our loan processors were so overloaded with business that they took me off the teller line to go into this back windowless room and help the loan processors out. And I remember looking at these, and I didn't really understand it, but I remember these folders just coming across the desk. It was 85% first mortgage, 15% HELOC, home equity line of credit, 85 15s and 90 10s. People's homes were 100% mortgaged at that point. And it just was coming in faster than we could do anything about it, which should have been the first warning, because we all know what happened a few years later.
Yes, but at the time, it seems this is normal. I mean,
Liz should have been
Everybody
in The Big
was
Short
doing
with
it.
Danny. You know how in the movie they go down to Florida and they're
and they
looking
meet
at all
that
these
guy.
people. And if they had met Liz Young Thomas, that would have been amazing.
Right?
She was in a windowless room.
Well, that would have been perfect for the whole thing. All right, let's move to retailers here. I guess to staple retailers away from what we would say are discretionary retails in a Home Depot. I think that is a good little split screen, how you guys talked about that, because again, it'll be interesting to see how it plays out. Walmart is up 31% on the year. Costco is up 31% on the year. Amazon's only up 11% of the year. Now, there's a lot of other things going on with Amazon, but if Amazon is also a AWS powered story, and obviously there's some Gen AI there, it is kind of interesting the outperformance of a Walmart and a Costco. Walmart reports tomorrow morning before the open. The implied move is about 5.5% in either direction. The stock on average over the last 4 course, has moved about 5%, guy. You see this uptrend, maybe 65, would be a level there. You see the 200-day all the way down there at 60. We know it trades at a premium to the market, and you're going to tell me why you think in this environment it should trade at a premium.
I think, and Elizabeth knows this, I'm sure, but I think they're now the largest grocer in the United States, number one, which is very important for their margins, which is why they trade at the premium that they trade at, not only to the broader market, obviously, but to a name like Target, which is probably trading not half of the valuation, but probably pretty close, number one. Number two, I mean, the environment that they find themselves in, I think, I mean, this is sort of peak Walmart in terms of what's going on. The higher end is trading down. I mean, people that have always been at Walmart are still there, and they're reaping the benefits of that, I think. If they were to miss for whatever reason, and I don't really, margin miss or something, that could send some shockwaves through the market. Now, I'll tell you, I think this is going to be steady as she goes, and I think you stay with Walmart, but I think there should be some concern that if they say something where, not only are we seeing people trade down, but now people are trading down from us, that's problematic because you're seeing
heavier discounting too.
You've seen it in the dollar. I mean, throw up a Dollar Gen chart. I mean, it
comes out DG.
Comes out DG. I mean, this stock in the fall of 2023 traded down about 102, 103, bounce, but there is no bounce whatsoever in any of these dollar store names, and I think that speaks to a strapped consumer.
Liz, Guy just mentioned, a Walmart trading double the multiple of a Target. Okay, 28 times for like single digits earnings and sales growth, and maybe more in the mid single digits. Then a Costco trades at 53 times this year, 48 times next. Now they have high single digits earnings growth and probably mid-ish single digit sales growth. And listen, we get it. There's a recurring nature of their membership. I think it's below 5% of total revenues. So like when you think of some of these retails that people are trading down to, do they deserve that sort of multiple relative to a market that most people think is expensive at 21 times?
I mean, it's hard to argue that something like Walmart or Costco, which is not necessarily a huge growth story, neither of them are big growth stories. It's hard to argue that they deserve that multiple, but I think it does speak to the environment and it speaks to what investors care about. We are now in the midst of what I will call consumer palooza earnings. So Walmart is tomorrow. Obviously, we've got Target on the 21st. If you just look down this list, we've got Dollar Tree on the 23rd, all of this, right? You Best Buy, Dollar General. So we're going to hear from a lot of these companies. I think the importance of Walmart is much like some of the big banks, maybe it's JP Morgan or Bank of America, because of how much information they have on the consumer. They have grocery shopping information. They have other consumer products information, and they have such a wide reach that they just have a better lens into what consumers are actually doing. We also have to remember, I know you compared it to Amazon a little bit, we have to remember what the key is for these companies to actually make money and maintain margins. In my opinion, the key is inventory management and making sure that they can forecast out as accurately as possible what consumers are going to buy so that they can manage their inventory according to that. And we know that Walmart and Target both had inventory issues a couple years ago. So I think maybe one of them has managed that better than the other, but I think Walmart just in and of itself has a much better lens into the consumer, particularly some of the lower end consumers.
I agree with that. Walmart, I think you're right. They both had their issues with inventories. Walmart seemingly only happened for a quarter. Target was seemingly a couple different quarters, and they've been punished for it accordingly. And I'll say this as well. Target sort of finds himself in that no man's land of being in the middle in the retail world, which is not where you want to be. And it's not you want to be on the low end anymore, without question, as the dollar stores suggest. But low end when you talk about like a Costco and a Walmart, if you want to throw them, and then throw TJ Maxx in that mix as well. And on the other end, maybe on the higher end, there's still some sort of buoyancy. But now you're seeing with specialty retail, Dan, where there's no real place to hide on the retail front.
Hey, go to a Walmart, go to a 5-year, because I think it's important what Liz just said about the kind of inventories coming out of COVID. Like both of these companies got turned around a little bit. And if you look at that that move in Walmart, and I want to say, was it late 2021 there? And obviously since that gap and since it's kind of been, off to the races here a little bit, that breakout, it's been a runaway breakout. So that's really interesting to think about, Guy. If there was a trade down from Walmart, then they're going to be offsides on inventories. And
100%.
that would be the thing that could just kind of pick itself up out of nowhere when people are pretty crowded in this trade also.
Well, I'm not expecting, I want to be clear. Like, we've been Danny Moses has been talking about Walmart for the last couple of years, Elizabeth as well. I mean, we've been, I think, collectively right about Walmart, but I'll throw this out. If their commentary is such that scares people, that could be one of these triggers for the market.
Yeah.
Walmart is that important, in my opinion, that if it spooks the market for whatever reason, in the form of inventory build, margin degradation, comps weren't, whatever the hell it is, that could be the thing that spooks the market.
All right. So it's interesting what you said, spooking the market here a little bit. I go back to 2007. It was November. Cisco was still a really important stock in the market because not only did they have tremendous geographic exposure and then in the enterprise, but also government. And they had this guide down in early November, and that was it for the NASDAQ. I'm just telling you, that was it. Now, a lot of the weakness in the market over the next year and a half had to do with the banking system, right? Not much, but sometimes there's like canaries in the coal mine here. And what that showed me is that there was a pullback in some of the end markets that, buy their routers and switches and all that sort of stuff. Let's look at Cisco here. They report after the close tonight. Okay. And you can see that the implied move in either direction is 7%. Average move over the last 4 quarters has been about 4%. This is a stock that has massively underperformed mega cap tech here because it's becoming less of mega cap, if you will. Let's look at a 5-year really quickly here. And then we're going to work our way through this quickly, guys. I want to get a sense. So look at that. It's basically coming up right on that uptrend that's been in place from the COVID lows. And this is one I want to go back to 25 years ago, because in the height of the internet bubble, it wasn't Yahoo or Amazon that were the largest market cap companies in the world.
Cisco.
It was Cisco, which was kind of like the NVIDIA of its time, if that makes sense.
No, 100%.
Okay.
I mean, this stock made an all-time high. I want to say, you know this probably to the day, Dan, but I want to say it was like March of 2000 or something around there. I mean, that's 24 years.
So look at it. It's
or
also
so ago.
one of the only mega caps that has not gotten back to its bubble highs, which I think is really interesting. Now, look at that uptrend that's been in place for the last 10 or so years. I mean, we're sitting right on it. Guy, what do you also see over the last year or so? You see that little formation that's sitting there?
It looks like a little head and shoulders is what you're saying.
There
a little mini one for sure. I also would say if you go back shorter term, since September of last year, Amanda, if you want to throw that up, you've had since it traded $58 or so, you've had that series of lower highs and lower lows, which is still intact. So there's a lot to watch here without question. And I don't think I don't think you're saying this, by the way. It's not a bellwether for the broader market, but
15 years ago.
Yes, it was
25 years ago. One quick point, Liz, and I want to get your take on maybe CapEx or some of the stuff in the enterprise or buyers of these sorts of things. If you were to look at the options market, okay, so we said 7% in either direction. Well, if you were to pick a side, let's say you had a directional view on this sort of thing into the print, that's 3.5% for an at the money call or put. Let's go to the 5-year chart for a second. So the 45.5 weekly put that expires on Friday is about $1.50. So it's a little more than 3%, right? And I look at this and I say to myself, if there was ever the potential for the sort of flush that Intel, maybe Amanda can pull up Intel for a second, it's just a final bloodletting. They've been value traps, you know what I mean? Like there's no real growth there. There's really nothing that's going to convince investors on this call or the guidance that they should just kind of get in this thing. So I don't know. I just think that this one, there's some risk to it. If it pops after it, I think you probably sell it. But look at that Intel gap to new multi-year lows. So Liz, thoughts on tech in general? Because the last point I'll just make here is that it's an interesting circumstance where the S&P is up like 14.5% on the year and the NASDAQ's up 11.5% or so. That's not something you see too frequently.
No. And what's interesting about what you said before is that Cisco guided lower, and that was kind of it for the market back in the early 2000s. That's obviously not going to happen this time. It's not going to happen with Intel either. If some of these companies guide lower, I think there's only one company that can guide lower and take the whole market with it. And if you look at just the expectations for volatility on certain days in the next, call it 2 weeks, the biggest expectations, the highest volatility that's expected it was today, which didn't really materialize because of CPI, Jackson Hole, NVIDIA earnings, and then I think maybe the jobs report in early September. So NVIDIA has now become a major economic release and something that can move the entire market's volatility. So we've shifted from what's important to listen to and what's not. And if it was consumer companies, we've heard from plenty of consumer companies who have guided down and worried about the consumer, hasn't done much to the overall market at all. So I think that's something to heed a warning of if you are still very overweight, something like
Guy,
NVIDIA.
quickly before we move on, you want to take some questions, right?
I got them right
but
here
quickly
listed.
before we move on. So initial jobless claims, that was Thursday, right?
We never talk about.
We never talk about. And so what percentage of the panic into that Monday morning do you think was consumer related here, job, all that
Ooh, I
sort
have
of
a
stuff
chart for this.
versus
Do you? Do you have it with you?
Sort of, yeah.
was it in the
was column
demoted? Was it
today.
in the
It's
demoted?
It's in demoted. Yeah.
Okay. It's been demoted towards the end of the show, obviously.
I'm bringing
but
it back up. Promoted.
I know, but promoted. What percentage of that little panic do you think had to do with, let's say, the yen carry trade versus what's going on here?
The trigger that triggered the rate move, which then subsequently. So I think that was.
It made the yen carry trade.
Yeah,
that
I
much
mean,
more,
again, you have it, so I'll let you answer it. But I think that was, you wonder sometimes what's the straw that's going to finally break the camel's back, and for whatever reason, it was that. But I think the seeds were sown long before. We were sort of headed that way, and for whatever reason, that was the final straw.
Well, so Liz, it kind of crescendoed a little bit because as the calls for rate cuts, like got dialed up here, it would only make worse, right? That situation with the carry trade because of the differential. But do you believe that the BOJ said, they reversed themselves so quickly within a week? Do you believe them? Do you know what I mean? Especially if the Fed indicates next week at Jackson Hole that they are on a glide path to 25, possibly 50, depending upon what that August job number looks like.
The Fed or the BOJ?
Well, I mean the Fed, like you know what I mean? Like, does the BOJ, if it looks like the Fed is going to do 25, possibly 50 at September, the BOJ has to stay pat, right?
Maybe. I think the BOJ is trying to avoid what happened last week and early this week. But interestingly, that move, the rate hike from the BOJ was on July 31st. This didn't happen until August 5th. So it wasn't an immediate reaction. It couldn't have all been about the carry trade. It was certainly something that piled on, but I think positioning piled on too. And we talked about it earlier. If people are still positioned off sides for something like that, that just exacerbates a move like that because then you end up chasing it. The chart I was talking about, and this is just about basically what the market reacts to and how it's changed. The tone has shifted. It's a bar chart. If we can bring it up, it's just blues and magentas. Basically, what we're seeing is that if you look at what's happened January through July, the reaction to CPI in the market, way bigger. That's the blue bar, way bigger than what's happened in August. Suddenly, we don't care anymore. The jobs report, January through July, that's that blue bar. Smaller, and now it's huge. Look at jobless claims, okay? January through July, we barely cared, and now suddenly we care more than we've cared about any of the other data points. So the tone has shifted. The market is more sensitive to these data points.
You think it's positioning largely?
I think it's positioning that exacerbates the move, but this shows us that it wasn't just the carry trade. There were other things that made people nervous. There are other things that have the potential to make people nervous. We came into that, I think, in a fragile place, and then we just kind of got flicked over the edge by this carry trade thing that everybody thought could be contagious. And frankly, I don't think many people even understood what was going on or why it mattered.
Well, we did our bit trying to explain it a little bit. Danny Moses, he was like,
we tried,
that's
baby.
what happens with fear.
So
right?
Guy,
it just keeps fear begets fear.
On your Spotify playlist of 900, how many songs?
It's almost 900 now.
Wow.
By
the way,
any Genesis songs? Because what song did she just mention there?
Are there any? You asking me?
I'm asking. Question? Are there any? You think there's zero Genesis? No Genesis? But she just said, "I don't care anymore." You remember that one?
Yeah, I do.
Horrible song, right?
Horrible song.
Yeah.
It's amazing how shitty Phil Collins. I mean, I'm sure he's a lovely guy.
You think he topped out in the air tonight?
Guy.
You love that. Back in the early 80s, you played
the air tonight.
You played the air drums.
No, I did
yes,
not.
You
no,
I
did
that song.
Okay,
80s.
You're saying that I did. I'm telling you that I
not
did not.
Once.
Ever.
I mean, I did that like last week.
All the time.
Now I saw Mike Tyson do that in
in The Hangover.
In The Hangover,
that was really funny.
Mike Tyson can do it because he's Mike friggin' Tyson.
Yeah.
For me to sit there with a bunch of my slapdick friends, that was for you, Bill, and to do air drum, it's just a bad look.
You know what?
When you're a guy right now,
Am, like 83, rocking,
like
T-top. Yeah, you were.
No, I
probably
don't do those things. I'm not, just so we. I think people have come to realize I'm not a particularly fun person. I don't hang out with dudes. I don't go to the bar and have a pint. It's just not my thing. So playing air drums is clearly not my
What's
thing.
your kink, guy?
I would look at disdain. Like when I saw people like that, which you obviously see, I would look to sort of an altercation like you just had.
Dust
like
up.
I would
Yeah.
seek that.
All right.
Oh,
Okay.
I don't know how
I'll
we
try to
got on
find
this.
that one.
So
my
the answer is
bad.
no,
All
I
right,
don't
should
have
we do a
any.
couple questions before we
I
go
got
here,
it.
guy?
This is for Elizabeth.
Thank you.
From Gary Webb. He's with us
Hi,
every
Gary.
day. Do you believe that inflation or disinflation represents a greater risk to the equity market? In which environment does gold do better? Good question.
Yeah, disinflation, I believe, at this point, but I think that just changed. I think that represents a bigger risk. I think it's going to cool faster than people expect it to, and that is not going to be well received, in my opinion, by the equity market because it just starts a snowball effect. If we get cooler than expected inflation, we suddenly bake in more cuts. That starts to look like a panic, and then the market panics after that. If that were to occur, I think that is good for gold.
This is from Starry, who is here every day as well. Ask them, that's us, how is it possible for the market to be bullish on accelerating rents in the context of a weakening consumer? I don't know the answer to that. I mean, people are feeling, that was sort of my point before. I mean, if you look at the rent component of this thing, it is still problematic.
Mm-hmm.
And all I think, and this is, again, just my opinion, all rate cuts are going to do, they're not going to fix that part of the equation. They'll just make it worse. So I don't know how that's possible because that is affordability. People can't afford. They have to rent. Rents are through the blah, 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 blah.
Yeah. 90% of the rise in CPI today was owner's equivalent rent.
Mhm.
So that's what really the crux of the question is. Honestly, I think people have started to just ignore it as something that doesn't matter, or it's mismeasured, it's misstated, so it doesn't matter as much. There is also a podcast that I put out about a month ago from Skylar Olson, who is the chief economist at Zillow. She talked about basically the sweet spot in mortgage rates, somewhere in the mid sixes, where then there's this break even where it starts to look more attractive to buy again rather than rent. We could hit that. And if mortgages keep falling, I think we're at 6.98 right now, something like that. So if mortgage rates keep falling, there could be a time where people aren't renting as much and you see that rent number come down, but then home prices raise.
I just said that earlier.
You said it?
I did say it. But Guy, you've been talking about, for 5 years, even when inflation was below 2%, that the increases that we're seeing in healthcare costs and education and the like, and those are not measured. So pretty interesting. When you talk to college, parents of college-age kids, and let's say like you did, Guy, you had 3 over how many years? 7 years or something like that. And the increases year over year, they were way higher than inflation. Hey, really quickly, because this was a question yesterday that I wanted to answer. This is from @John Brennan 6987. I don't think he's a former CIA head. That John Brennan,
698. So he's born on June 9th, 1987. Relatively young man.
All right. I still have the SPY 550 puts September 30th. So those are the quarterlies. We talked about those, I want to say a month ago. Keep them as insurance, right? Well, here's the deal. If I was long those, right here with the SPY at 543, they're basically trading in a high delta. So you have a little more than a month here. They're almost trading kind of like stock, that much in the money. So you should think about it almost being short SPY relative to what you have in your portfolio. So to me, we had the CPI, a pretty muted reaction. We can all agree. Next week, we have Jackson Hole. The week after that, we have NVIDIA. There's some market moving events here. And I think Jackson Hole, if he were to signal something that's a bit more dovish, right? Do you think after the data and the move that we had yesterday, does that cause the market to rally, guys? You've
talked about this, EY. Again, this is the be careful what you wish for doctrine of if they are more dovish, what is that saying? What do they see? What are they worried about? And is the knee-jerk reaction higher? Is it going to be muted? Or will there actually be a knee-jerk reaction lower because it's signaling something to the market? That's the rub, I think.
Yeah, recently it hasn't been welcomed when they are dovish, or even when the market decides that they should be dovish. That hasn't necessarily been good news. I think it does depend, unfortunately, on how he says it. If he says that he's actually concerned about what happened with the yen, because remember, this is the first time we're going to hear from him since that jobs report and since the yen carry trade debacle. So it's going to be really important the way that he frames both of those pieces. How are they feeling about the labor market? The last time we heard from him about the labor market, he said it was coming into better balance. If that changes and suddenly it seems like it's getting too cool, I think the market will react poorly to that. The yen thing, I don't know what he's going to say. I'm guessing something like the financial system is still stable.
Chrissy is asking you, Dan. Is there a price where you get Mobileye has been a disaster, by the way, the stock.
This is Mobileye.
And Intel is probably offloading its shares to raise cap. Yes. I mean, the one thing that actually is worth something to Intel, Intel's a disaster. I think we all agree on that.
Agreed.
But Mobileye, which is an $11 billion company, stock is not trading well. I believe we're making a 52-week low today-ish. Thoughts on that?
Yeah, so interesting. It's expensive relative to these earnings. They're adjusted. I think on a GAAP basis, it's not making money, at least this year. Expected to kind of make a little bit next year, but who knows? I don't know, man. It just seems like a lot of the errors coming out of this, autonomous trade. I think that if you just look at what the feedback is about full self-driving for Tesla, it's just not good. There's a Truist analyst. I don't know if you guys have seen this. It was about a month ago. He did his second test drive on full self-driving. His kid was in the car. They almost crashed. Okay.
Yikes.
He did another one this week or in the last week. Kid was in the car, and it also did a whole host of other things that you just wanted to do. So if a big part of the valuation of a Tesla is reliant on autonomous driving, it's just not there yet. And so if Mobileye makes a lot of the components that go into it, maybe not exactly for Tesla, it just doesn't seem that interesting to me. And I would say one other thing, Guy, about Intel, they also sold their ARM stake. Did you see that today? That was a headline here. So,
yeah, I mean,
interesting.
First for this Truist person, why do you have your kid in the car? Not only once, but twice. That's a Johnson move.
It sounds like it's
number one. Number two, here's our last question.
Yeah.
I'm going to ask Elizabeth the question.
Okay.
Okay. Do you know who Michael Stivic is?
No.
Or was? Michael Stivic. Dan?
I do not know.
No?
I don't have a guess.
That's unfortunate.
I bet it was the next New York Ranger or something like that.
No. Michael Stivic was Rob Reiner's character on All in the Family. So you say, why you bring? Because
he was Meathead.
It was Michael Stivic.
I know, but no one knows that. They know him. If you said to me, do you know who Meathead was?
Right.
I would have told you it's Rob Reiner's character.
And then I would say, what was his name on the show?
And I wouldn't have known.
Well, there you go.
Okay.
This is from Matthew Stevic. Question. Put this one up.
How did we get there?
Guy, thoughts on the Mets?
Oh, jeez.
So the Mets,
Matthew,
over their last 10 games, the
us?
Mets are 3-7. They just came off an abysmal showing in Seattle.
Would you say to Tim the other day when he walked in on Monday? You said something about
they were scoreless in Seattle.
Oh, that's what he said. It was genius because Tim's a big Mets fan.
Okay.
So listless in Seattle.
They didn't score one run.
They scored
one.
You
said listless in Seattle.
Yeah, they were outscored 22-1 in a 3-game set. They lost last night at home to there you go.
Look at Jacob,
now the
Johnny
Oakland A's, who have played better baseball without question, but still. You got to beat the teams you got to beat. They are 3 games above 500. They're a game and a half out of the wild card, I believe. They're looking up at the Braves. They're looking up at Arizona, who is playing good ball, and San Diego. So my thoughts are they're going to shit the bed the rest of the year, and they will finish maybe 2 games over, let's call it, I don't know, like a 83 and what would that be? Maybe 83 and 79. The math adds up. So maybe 4 over. Not good.
So, Guy,
the Brewers, by the way, are in first place.
So Yanks 71 and 50. You see your Mets.
Yeah, the Yanks go 29 and 12, which is very doable. Gets them to 100 wins. I think that's reasonable to think. They'll get Clark Schmidt back, as Elizabeth was saying, probably mid-September. They're starting to get healthy here. I think John Carlos Stanton is seemingly swinging the bat a little bit better. You obviously can't pitch to Aaron Judge. Soto is a stud. I think Verdugo has figured it out. LeMahieu seems to have figured out some of his stuff. I'm concerned about the pen, but you got some guys that might be getting healthy down on the farm. So I think they're as good as any team in baseball.
People ask Guy all the time, how do you remember all this stuff about the markets and this and that, whatever? Look what he just did with the Yankees roster. It's amazing here. Hey, listen, we got through the Mets without any 4-letter words. That's amazing.
Because I was told if you curse on these things, it's a bad,
the algo and all that.
The Mets suck.
Okay, that's a 4-letter word.
And before we get out of here, and this is true, but for emphasis, Bill, if you're listening, the Mets, all teams now play a balanced schedule. In other words, they play, if you're in the National League, you play American League. So it's all mishmash.
Interleague.
You play
Interleague
every team.
Play everybody the
Yeah.
same amount of
Yes.
times.
So
Okay.
that the schedules
They-
aren't biased in one
They
direction.
screwed
or
that up as
another.
well, by the way. When I was a young lad, I mean, there was a mystique about National League teams, like who is Roberto Clemente? And the only time you would see somebody like that be in an all-star game, that was like, whoa.
Uh-huh.
Now it's okay, fair enough. Let's say it's late September, which we're going to be there like this.
Mhm.
And the Mets were playing a 3-game set against the Red Sox, which could happen.
Okay.
Okay.
Uh-huh.
In order for the Yankees to make the playoffs, the Mets would have to beat the Red Sox, let's say 2 of 3. Because if the Mets win, the Yankees are obviously in the American League East, the Yankees get into the playoffs.
Okay.
Under those circumstances, with the Mets having to win for the Yankees, my team, to get into playoffs, who do you think I'd be rooting for, the Mets or the Red Sox?
The Red Sox.
That is correct. There is not a set
I
of
don't think it matters.
circumstances that exist.
I mean,
The Mets could be playing red effing China, and I will not root for them.
so what this confirms that he's got this tremendous baseball, and obviously it just confirms that he's a sociopath.
I know.
So that's
no.
all
I
it
mean,
does.
you know, what did I send you a couple weeks ago? This raw
True
dogging or
crime?
red
Oh,
dogging
You
thing.
know what?
Oh, I thought
No,
we were talking about
because
true crime
you've
again.
flown. You have you been on a plane with me? Maybe not.
No,
Dan
I
has.
have not.
It's
I've heard about it.
insane. He's insane.
Yeah,
I get
I
on
wanna
the
see it
plane
sometime.
as you
I
should,
just sit straight.
unencumbered. I sit down. I say thank you. You know, when they come by and ask me if I no, thank you, I'm fine. I sit and I stare straight ahead.
Uh-huh.
And I did that before anybody was doing that. Then
What are
the
you
couple
thinking
that
about when you're doing
I
that?
don't know.
Okay.
Sometimes I'm doing math problems in my head. I'm counting down. I'm trying to see how many prime numbers I can do until I can't do them
that
anymore.
sometimes.
He
All
leaves
kinds
his,
of
he leaves
things.
his suit jacket on, and he doesn't even loosen up the
Never.
tie or anything like that. He's
Huh.
old school. All right, we should get
No,
out of here.
but
guys.
apparently, can we put that in the show notes?
Sure.
That New York Post article, Amanda, look it
It's a
up
Gen
real
Z
quick.
thing now.
Yeah.
People do that.
Raw
I don't
dogging.
know
Yeah,
what
but it
is.
means
It's a
something.
thing.
It means something that you don't think it
Yeah,
means.
it's
It
a
means
no.
people get on planes now and
Nah.
stare straight ahead
It's not
at the seat in
not-
front of them.
Not safe for work. guy.
No.
That's it.
Mm-mm.
All right, let's get out of here. You and I have
I
a
know
2
there's an
o'clock.
article in the
Guy
Post.
and I are speaking to a graduate class at Columbia Business
Are we?
School.
Oh,
at
that's
2 o'clock.
exciting.
Yeah, do you want to stick around?
I
She
have
has
to
the
go
thing at
back to
4.
work.
Oh,
I have
yeah,
to- yeah.
All right. Well, we got to get out of here because
All right, that was fun.
To do.
Market Matrix, check it out.
Oh yeah, look, we got this new podcast. It's 14 weeks old, guy. Look at that right there. What we do is we curate what we think is like 10 of the most important business and market stories. We put it into Perplexity.
Sure,
we
we
ask
do.
it to summarize it. Then we put it into a voice bot. We call him Brunson, and he reads them to you. It's a great little pod. Go find it in your podcast store. It's MRKT Matrix. Rate it, review it, share it with your friends. Enjoy it.
Mets suck. We'll see you tomorrow.
See ya.